If you have an RRSP and aren't sure how to withdraw it when you retire, this is the right video for you. One of the most common questions I get asked is, when should I start taking out my RRSP and how much should I withdraw? And the answer is, well, it depends. In this video, I'll go over 5 different RRSP withdrawal strategies that will hopefully answer that crucial question for you. But first, let's go over why is an RRSP withdrawal strategy crucial. Many people focus on contributing and growing their RRSPs while they're working, but they often overlook the importance of a strategic withdrawal plan. You might be thinking, why even bother with an RRSP strategy? Shouldn't I just take out the minimum amount possible each year after I convert it into a RIF to grow it as long as possible and have it tax sheltered? Well, while that is a great strategy for many, there are a lot more things to consider. And the first thing to consider is avoiding the tax bracket creep. Now, the basics of RRSP is that withdrawals from it are taxed as income in the year they are taken out, which can push you into a higher marginal tax bracket. Here's a quick look at the 2024 combined federal and provincial tax bracket in Ontario. As you can see, the tax brackets can get really high in Canada and even exceeds 50% for some high income earners. So to minimize your tax burden, you must plan your RRSP withdrawals for years when you anticipate being in a lower tax bracket. Now let's get into some strategies and examples on how we can actually manage these RRSP withdrawals. I'm going to go from the easiest strategy to implement to the most complicated. The first strategy is strategic early withdrawal to maximize your CPP and OAS. This approach focuses on maxing out your government pension by delaying your CPP and OAS. You'll prioritize withdrawing from your RRSPs and RIFs for any income you need. Let's break down why this strategy can be a game changer for your retirement planning. Here's how it works. Instead of starting CPP at age 65, delay it until age 70. If you need the income during that time, start withdrawing from your RSPs and RIFs to cover your expenses until you reach age 70. This can lead to a huge 42% increase in your CPP. Note that you don't have to delay it until age 70. You could delay until age 66 or 67 or whatever age that you want if you really need the income. And I'll get a little deeper into the numbers here. I'll try to make it as clear as possible. So CPP benefits, here's how it works. At age 60, you will receive 0.6% less per month if you start taking your CPP at age 60 versus age 65, for a total of 36% less than if you had started it at age 65. Then at age 70, if you delay it till age 70, you'll receive 0.7% more per month than if you start taking your CPP versus age 65, for a total of 42% more. So for example, if you're going to receive a $1,000 a month CPP at age 65, now you'll be getting $1,420 at age 70. Okay, for your OAS benefits, at age 65, you'll receive the full benefit amount, but if you delay it to age 70, you'll get 36% more than what you would receive at 65. So for example, if your full OAS benefits at 65 is $600 per month, by delaying it until 70, you would receive about $816 per month, which is also another big increase. The benefits of this strategy, the first obvious reason is that it increases your CPP and OAS payments. By delaying the CPP and OAS, you'll have way higher payments from these programs than when you start taking them at age 65. The second reason is more financial security. This is great for someone who likes certainty because you're basically trading the uncertain returns of an RRSP for the guaranteed returns of your CPP, which also increases each year and is indexed to inflation, which is a very important point. And another great benefit of this strategy is to potentially avoid OAS clawbacks. If your net income exceeds $86,912 as of July 2024, you'll see a reduction in your OAS benefits due to clawbacks. So by spreading out your RRSP withdrawals, you can keep your income below the limits once you turn 70 and start collecting your OAS. With the maximum monthly payment amounts being up to $784 per month for OAS, this can equal to over $9,000 gained each year if you manage your income well. But this strategy isn't without downsides. It's not perfect for everyone. The biggest reason it might not work for you is if you are in poor health and are worried about how long you will live. Delaying CPP and OAS benefits makes sense if you expect to live longer, but if you have health issues or a family history of shorter lifespans, starting your benefits earlier might provide more total benefits. So be mindful of that. On the other hand, if you're in great health and have a family history of people living well into their 80s and 90s, this strategy makes even more sense for you. Another reason people don't like the strategy is that some people aren't comfortable with withdrawing too much RSPs and losing that tax shelter status for it. But this brings us to our next strategy and point though, which is minimizing RRSP taxes on death. And why this is important is that when you pass away, the entire balance in your RRSP is considered as income for that year and taxed accordingly. I was actually very surprised to learn this when I first heard about it. Here's why minimizing these taxes is crucial. First of all, you have to preserve wealth for your beneficiaries. By reducing the tax burden, you see more of your hard-earned savings go to your loved ones. The second reason is to avoid large tax hits. Without planning, your RSP balance could potentially push your estate into the highest marginal tax bracket, which results in huge taxes. Another reason is efficient estate planning. Proper strategies can help streamline the transfer of your wealth, making the process smoother for your beneficiaries. To give you a concrete example of how this works, let's look at a scenario where no planning is done. Let's say Tom has an RRSP balance of $500,000 at the time of his death. This $500,000 is added to his income for that year. Assuming an average tax rate of 40%, Tom's estate would owe approximately $200,000 in taxes on RRSPs alone. Now, this means only $300,000 would go to his beneficiaries after taxes. Let's explore some effective strategies to minimize the tax impact on your RRSP when you pass away. The first one is gradual withdrawal of your RRSPs, which involves drawing it out during your retirement years gradually and to reduce the balance over time. Try to focus on withdrawing your RRSP in low-income years to reduce the amount of tax owing. So for example, if instead Tom had started withdrawing $20,000 to $30,000 annually from his RRSP starting at age 60 and using his funds for living expenses, this would have reduced his RRSP balance and minimized the tax hit upon death greatly. Another great strategy is the spousal rollover for your RRSP. If you name a spouse or common law partner as a beneficiary, this allows a transfer of your RRSP or RIF to them tax-free, and it'll continue to grow tax shelter. The RRSP could just roll over to their RRSP or RIF without immediate tax consequences. So for example, if John names his wife as a beneficiary of his RRSP, when he passes away, the balance transfers to her RRSP, deferring taxes until she withdraws the funds. She can be the one to perform the gradual RRSP withdrawal instead. Note that it's important to look at the overall picture for this strategy. If you have a large RRSP amount and want to minimize the taxes to your estate when you pass away, this strategy could make sense for you. The next strategy is income splitting. Income splitting with your RRSP is a strategy where you transfer income from a higher earning spouse to a lower earning spouse. This reduces the overall tax burden since the income is taxed at a lower rate for the lower earning spouse. Let's break it down step by step. To start, you need to convert your RRSP to a RIF once you turn 65. This allows the income from your RIF to be eligible for income splitting. Note that you must be at least 65 for this strategy to work. You can allocate up to 50% of your eligible pension income, including RIF withdrawals, to your spouse. This is done on your tax return. And by allocating this income to the lower earning spouse, you reduce your combined taxable income. So let's look at an example. Jane and Bob are both 67. Jane has a RIF and has an annual income of $70,000. Bob has no RIF and only earns $20,000 from some part-time work. By splitting Jane's RIF income, she allocates $10,000 to Bob. Now, Jane's taxable income is $60,000 and Bob's is $30,000. This income splitting strategy lowers their combined taxes significantly, and all it takes is a little bit of calculations and paperwork. The beauty of this strategy is you can play around with the withdrawal amounts to control your income and maximize your tax savings each year. And how to claim this on your tax return: both spouses must complete Form T1032, which is a joint election to split pension income, and include it with their tax return. This form makes sure that the income split is correctly reported and both parties benefit from the tax saving. Contact an accountant if you don't want to do this yourself. Next up is using your TFSA wisely with your RRSP. So how does withdrawing from your TFSA fit into your retirement strategy with your RRSP? The key is to use your TFSA withdrawals to supplement your income while minimizing taxes. Here's how it works. Let's say you have multiple sources of retirement income. You got an RRSP, CPP, OAS, and a TFSA. RRSP withdrawals are taxed as income, which can push you into a higher tax bracket. CPP and OAS are also taxable. But the key thing to note here is that TFSA withdrawals do not count towards your income. So here's an example. Meet John. John is 68, retired, and receives CPP and OAS totaling $20,000 a year. He needs an additional $30,000 to cover his living expenses. Instead of withdrawing the entire $30,000 from his RRSP, John takes $10,000 from his RRSP and $20,000 from his TFSA. The RRSP withdrawal is taxable, but the TFSA withdrawal is tax-free. This helps to keep John's taxable income lower and helps him lower his overall tax rate. The key point here is that you can use the TFSA in many cases to control, again, how much your taxable income is each year and help to keep you in your desired tax bracket. The TFSA can also help to manage excess funds from your RRSP. There might be some situations where you want to withdraw more from your RRSP, such as reducing RRSP taxes on death that we went through earlier. So it's a good idea to put those excess funds into your RRSP. So as an example, meet Sarah. Sarah is 65 with a sizable RRSP and TFSA. She needs about $40,000 annually for living expenses. She withdraws $40,000 from her RRSP, which is taxable income. But then she wants to withdraw more from her RRSP, so she takes out $20,000 and contributes it to her TFSA. And since TFSA withdrawals are tax-free, she can access these funds whenever needed without any additional taxes. By moving excess funds from your RRSP to your TFSA, your investments continue to grow tax-free. Also, since TFSA withdrawals don't count as income, you still qualify for government benefits like OAS or GIS. You must make sure you have enough TFSA contribution room for this though, or you'll get fined by the CRA. So let's check before trying this. One of the most complex RRSP withdrawal strategies is called the RRSP Meltdown strategy, otherwise known as the RRSP Freeze. This involves taking out a large loan to invest where the interest payments on the loan are tax deductible. Then withdrawals from your RRSP are then used to pay the loan interest, offsetting the taxable income from the RRSP. Confusing? Absolutely. Now you might think to yourself, why on earth would you complicate things like that? Well, let's look at another example. Meet Mike. Mike is 60 years old and has $500,000 in his RRSP. He's retired early and his income is relatively low. Mike decides to take out a $100,000 investment loan at an interest rate of 5%. I know 5% is low, but this is just for simplicity purposes. He uses the loan to invest in a diversified portfolio that he hopes will return 7% annually. And then every year, Mike withdraws the $5,000 from his RRSP to cover the interest on the loan. This $5,000 is added to his taxable income. And at the same time, the $5,000 interest payment on the loan is tax deductible, offsetting the RRSP withdrawal tax. This, in effect, melts down the RRSP each year as you progress through this strategy. Now let's go over the positives and downsides of this strategy. One major advantage of the strategy is the tax savings. Because the interest payments on the loan is tax deductible, Mike minimizes his tax impact. Also, the investment loan grows in a non-registered account, and this benefits from capital gains and dividends, which are taxed at a lower rate than regular income. However, this strategy definitely has a lot of downsides. There's a lot of risk. The biggest risk is market risk. If Mike's investments don't perform as well as expected, he could end up losing money, making the loan repayments burden. Also, interest rates could rise, which could increase the cost of borrowing significantly, which adds even more risk. Another thing is that this strategy is quite complex and involves a lot of steps. Applying for a loan and managing a loan while making strategic withdrawals and investments requires careful planning and monitoring. It's not a set it and forget it strategy, and it could take quite a lot of time for you to stay on top of your investments and be ready to adjust your plan as needed. So who is this strategy good for? Well, I would not recommend this for the vast majority of people in Canada. This strategy might work for someone who has a very high risk tolerance, high passive income, a large RRSP portfolio, and other significant retirement income sources. I would only consider this strategy if I was willing to accept potential very big losses in my RRSP portfolio. So I would have to make sure I have quite a big portfolio to cover any such losses. Okay, so putting it all together. I know we went through a lot of examples here, but think of managing your RRSP like orchestrating a symphony. Each instrument must play at the right time for the music to sound perfect. Your RRSP, TFSA, OAS, and CPP, they all must work well together to be in harmony and maximize your tax savings. Strategic timing of your RRSP withdrawals ensures you get the most out of your retirement savings without paying unnecessary taxes or losing benefits. For example, if your RRSP withdrawals are too high, they might drown out the benefits of your OAS and GIS from clawbacks, similar to how a loud drum can overwhelm the melody in a symphony. We went through 5 different strategies here, and what I want to stress is that there is no one-size-fits-all method for everyone. For some people, it might make sense to withdraw their RRSP early to get a larger CPP. For others, it might make the most sense to take out the minimum and try to build up their RIF as big as possible. Also, maybe it's not that important for you to minimize RRSP taxes at your death, and you'd rather have the security of having a nice and big RRSP. It really all depends on your financial goals and specific unique situation. So at Blueprint, we use financial planning software that will help you answer these important questions, such as when you should start your CPP payments and when you should also start withdrawing from your CPP and how much. And what happens if you take out a combination of your TFSA and RRSP, and how does that affect your total estate upon death? We also run multiple scenarios to figure out how much money you could spend in retirement and what will happen to your retirement if your RRSPs don't perform as well as you thought. Check out a link to our services in the description below. There's also the blog post for this video linked as well. Don't forget to like and subscribe to the channel if you found this video helpful. And as always, thanks for listening.